Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, February 25th, 2022. It is 11:26 a.m. Eastern Time as I'm starting the video, and what we're going to do here is to just focus on the equity markets in this one, and we'll keep it consistent. I'm going to walk it down from the longest term time frame that I typically follow, and those are monthly charts, meaning every candlestick on this chart represents 1 month of trading action. We're looking at QQQ, the tracking ETF for the Nasdaq 100. Might really probably overall at different times I'll trade different indexes, but one of the my favorite trading proxies or indexes to trade. And we're going to walk it down. I'm going to go from a monthly, weekly, daily. There's infinite number of time frames you can do. You can do 60-minute chart, 2 hour, but we'll do the ones that I usually harp on: monthly, weekly, daily, 60-minute, and then I'm going to take it all the way down to the 5-minute chart for you active traders, or just some things to look for. Even if you're a swing trader, to just time entries or exits if you're micromanaging your positions, meaning adding on to or reducing, if things happen. So we're gonna talk on that. We're going to talk about those divergences I pointed out the other day. They continue to firm up. And that's it. And then we'll see how the week closes, especially when we get to the weekly charts. Now the month, well, we have that too. Let's see. Today is, what is today? The 25th. So we have one more trading day, Monday the 28th, last day of the month. So I can speak to this chart now and tell you without just about near certainty nothing's going to change on this time frame. Okay, so I know you can't see much in the video, but what you have down here is the PPO, and it's PPO. I often talk about this. It's a close cousin of the MACD. PPO is going to work a lot better on charts with a large differential in price. And what I mean, you look at the low, and again, any stock, any index, and so when you look at the Qs right here was $10 or so, and recently is up about $450. That is a very large price differential, and PPO is going to do a much better job in those instances than the MACD. Shorter term time frames, there's hardly a discernible difference at all, but longer term it does make a difference. So all right, so what are we looking at? All the corrections, and all these, the corrections coincided with these red bars where the PPO crossed over. That's what you have on the histogram. I've gone over this many, many times. In bull markets, those corrections ranged, in the low double digits, 26% right there, 24, even 31, which again, I still consider that a correction because all we did is come back to the primary uptrend line right there. And then in bull markets, when you get these crosses, remember, this is either going to be, in hindsight, we'll either say this was just another correction, a great buying opportunity in one of the strongest bull markets in history, or it was the beginning of a new bear market. If it's a bear market, then you're looking at drops that range in the mid to upper double digits. So again, just to take away, and something we'll continue to monitor, because all that really matters is how we close the month. So let's zoom in nice and tight here. And what we're looking at is this trend line here. It's a minor trend line. It really comes off the lows back from 2018. We had that big fourth quarter 2018 drop into the end of the year. And if you look at that, we had a break of it. And again, I maintain, and I have very little, no doubt in my head, that if the Fed hadn't taken out the nuclear option, both the Fed and the Washington, the federal government, that would have been the start of a new bull market. And again, you could call it new bear market. But again, they deferred it and pumped tremendous amounts of liquidity and stimulus into the economy and the markets, and so that's what we had. So, and my point is, what I'm getting at is, if you look at that, what happened is we reverted back to the mean. Once they stepped in, saved the day right there, that trend line continued just as it did since back here, act as support, and it's just done a great job. Look at all these candlestick, either the shadows, the skinny part, or the fat part, the body. Look how many tags we have on it. And then we had a breakdown, and it wasn't just a meander down through there, it was a solid close and a follow through. So that is a 110% sell signal on the monthly chart by that indicator. However, to make the case of a bear market versus a correction, again, let's not get tied up in the percentage drop. So far from high to low, the Nasdaq 100 dropped just over 22%. So technically speaking, a bear market by the old definition, but I don't go by the old definition. We're in a different era than we were 50 years ago or so. With the in modern day markets, there's just tremendous amount of volatility, especially with the Fed's heavy hand in the market. And so again, and also this index. Keep in mind, this is a higher higher beta index than the S&P 500, and usually the mainstream media is going to quote the Dow or the S&P as far as bull and bear markets, and the S&P didn't drop 22% yet. Okay, so what happened there is, so yes, a sell signal, at least as far as a break of that trend line, also confirming trend indicator flipped to bearish last month with a solid red close and is guaranteed to close with another red, even bigger histogram. That means the PPO has crossed over and has clearly crossed down. And again, I already went over all the numbers many times in the past. What each and every one, without exception, going back decades, what each and every bearish PPO crossover, the correction that's been associated with during that time period. And again, I measure from highs to lows. So you can see here I have, well, if you can't see it in the video, it says 22% with question marks. And I put question marks there when I'm measuring a drop that I don't believe is likely over. So that's why I measured that out. That's so far from high to low what it's been. And I think there's more to come. However, again, we're on a monthly chart. One of my favorite indicators, I've talked to many times over many years. I give it a 10 on a scale 1 to 10 when you factor in effectiveness combined with simplicity, because you get extra points for a simple thing that this is trading for dummies or investing. Actually, we're on a monthly chart. So this is investing for dummies, and I'm referring to the books, DOS for Dummies and Windows for Dummies, that whole series of books. I'm not saying that anyone out there, if you're new to investing, it's just simple. And you can see, again, when I use trend lines, it's not the monthly drop. That's where the shadow, the skinny part, doesn't matter. It's how you close. You want to look at the body. So there's a successful defense after an intra-month break. Another one right there. And look at all these tests. You go back in time, and you can see that 20 period moving average on the monthly chart is literally one of the best trend indicators out there, especially factored in its simplicity. When you cross below it, as you did here, you back tested, you are in a bear market. When you cross above it, you are in a bull market. And once you're in a bull market, pullbacks to that 20 period EMA act as support, and that's where you want to buy if you're a bull. But when that level goes, and especially a solid close, and as I always say, the redder the better. Sometimes you'll have a slight incremental close below, but if you have to look that close, then you might want to give it a little bit benefit of the doubt. And again, I talk about investing because this is 401k stuff. If you just simply use this for the past 30, 40 years, you would have vastly outperformed the market to a huge degree by being long when the Qs are above it, or the S&P 500, and then short or out of the market if you don't short when it's below, and then you get back in when it gets above. So, okay, the takeaway is, boom, we hit it. We went through it intra-month, but so far there's been a stick save, and barring any crazy move down in the next day or so. Remember, by Monday, that's when this candle will be finalized. We'll probably close above it or close enough on it that we won't be able to say with definitively that we have a sell signal there. So I just wanted to point that out, that right now, by that metric, all this has proved to be is a pullback, a test that level. And again, if you go back for many years, that was some of the best buying opportunities you've had. They got you in during the corrections. But again, it's a monthly indicator. I don't use that as a timing indicator. Now we're going to step it down. But should that level go, whether it's this month, next month, or 6 months from now, my target would be the primary uptrend line. It's a very clean, well-defined trend line. Comes off the 2008 lows in the Nasdaq 100 in November of 08. We checked it again in March of 09 when every other index bottomed. The small caps, mid caps, Dow, S&P 500, they all bottomed right there. And you've had a few checks of it. All these big corrections that we've had in recent years came back to that level and that trend line. So that is my target. And I can say this, when you get far away from a well-defined primary trend line like you did here, 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 and very much here, there is quite often a reversion to the mean. And again, I want to just say that's a minimum target where I think we're going, and I think it'll be hit this year. And from where we're at right now, you still have, we're towards the bottom of that monthly candle right there. To hit it, you have another 23% downside. Again, I'm just ballparking where it would be hit. Let's just say that that comes in about the end of April there. That's April 29th, call it the beginning of May, if it went at that rate. You know, and the thing about it, what I'm talking about is trend lines are dynamic, meaning they come in at higher and higher prices as time goes on. So if it took, you know, until, let's go back here till, let's say, this fall to hit it, back in, let's say, early August, then it's now only about an 18% drop. Okay, so you get that. But the way things play out, if it's going to happen, I think it'll happen sooner than later, and so that gives you that, again, ballpark 22%. All right, we're going to walk it down now. Let's go to the weekly. Enough there. All right, this is an important time frame as well for swing and trend traders. You had that big level there, 342 was my, you know, roughly 342.16 is what the number says. That was my first target from the short entries that were all the way back here, and then multiple short entries since, objective add-ons. It was a major reaction high, all-time high there. Got checked again. Finally, Nasdaq 100 broke out there, came in for a near back test, and a lot's happened on this chart. We'll zoom in. So the things that happened since then, you had this minor trend line break there, which got us short initially. Then every push back to this level, about 400. I mentioned those as objective short entries or add-ons. Then we broke this key trading range right there, that sideways trading range, another objective short entry. We also took out at the very same time this uptrend line, well-defined uptrend line, which really gives us this price channel here. And again, so those were dual sell signals there. Then we went on to take out the key 40-week moving averages, both exponential and simple, right here, the blue and red lines there. So again, all I'm saying is check, 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 check. We back tested them there and then got rejected. So that's also a check. And then we went on to take out T1, which was my first target and big support right here this week, in fact. And now we're back testing it. So this is an important level. And how we close the week today will tell. Now look, we're so close that for all intents and purposes, if we close where we are right now, we're just a hair above. And again, it's a rough level. It's not exactly 342.16. It's roughly that level. So anything here would simply be a back test. Should we close way up here or next week we build on it, then I'm going to say that level's been recovered and this was a false breakdown, and I'm going to say, yeah, bulls get a check mark for that for sure, for regaining that level, especially on a false breakdown, because that probably sucked in a lot of shorts yesterday and they're being ramped up. So okay, that's that. And if that happens, then the bulls still have their work cut out for them. You have the 200 days that you can see the 40-week exponential is already rolling over. The exponential moving average, by the way, guys, the only difference is how they're calculated. It will respond faster to prices. So it takes a little while longer for the 200 to roll over, but we can already see the 40-week exponential moving average has turned down, indicating the trend has changed. And last time that happened was right here when COVID hit. You can see the red line turned down as well. And the time before that, you'd have to go all the way back to the last probably big correction or bear market. Okay, so that's what to look for on the weekly chart. And I don't, you know, based on where we're at now, I don't expect big fireworks today. I'd probably, well, I'll get to the short-term charts in a second and show you what may trigger a little sell-off into the close today that'll probably park us down around that level. Daily chart. All right, this is important. Here's those divergences I've been highlighting for the last week or so, and they are firming up. They are not the be-all, end-all, but they are certainly, in my opinion at least, certainly worth noting because they're rare to see positive divergence, such clean and, you know, when I say clean, see how you have two distinct troughs in there, and both the RSI and PPO. That's the kind of divergence I like versus like a flattish MACD, and they're powerful. Now, We are below. There's a lot I can pick apart going from top to bottom. So you have the positive divergence on the RSI. You're coming off oversold conditions. Positive divergence on the PPO. And that is nothing but bullish. It's not yet confirmed. Will be if you get a bearish crossover. And even that doesn't guarantee you're going higher, but it just increases the likelihood. That's all, guys. Sometimes these lines look like they're going to cross, they kiss, or they briefly cross. You get a whipsaw, and then we go down. It's just something we have to monitor. You know me, I'll give you my thoughts on what's probably going to happen, but again, you have to respect what does happen. And right now, the fact that we have those divergences and they're still buying the market up after yesterday's strong run-up tells me whether or not, you know, I mentioned yesterday about the PPP, told you can look into that, and that it wouldn't surprise me at the least. I would put good money, very good money, that Biden and the White House called in, you know, the big banks or whatever powers they have, whatever their PPP team is, and said, hey, guys, this is bad, oil's skyrocketing, Putin's, you know, just dismissing me. We got to do something or the markets are going to crash and this whole thing. And so, again, whether or not it happened, it doesn't matter. When I'm short or long, all that matters, it doesn't matter who the buyer is, if it's natural buying or artificial buying. Artificial meaning the banks, if the big banks or whatever, you know, whatever capacity the Fed might have to step in, and there's been talks of that too, whether they outright buy for, futures. It doesn't matter because there were buyers. But where it does matter is, and only time will tell, were they natural buyers yesterday? Again, based on the headlines, and I ripped through them yesterday, and there wasn't a single positive or bullish headline. About the only thing bullish yesterday, I think, would be the defense stocks, Boeing, Raytheon, those kind of companies, General Dynamics, IT. There's an ETF, I think it's ITA, that tracks those. You know, because now that's just going to increase the fire up the hawks, you know, the warmongers, and increase defense spending for NATO and all that good stuff. So, you know, if any sector should have benefited from what happened with Russia invading Ukraine, would be that one. And again, there was a little bit more of a drop down, the odds for the 50 basis point rate hike decrease. But other than that, doesn't seem like if anything, the fundamental catalysts were all nearly nothing but negative, and yet there was a lot of buyers stepped in. So where I'm going, I know I might sound like I'm rambling here. Time will tell if those were natural buyers, meaning investors like you, me, pension funds, hedge funds that are buying because they believe the long-term prospects. They think Apple and Facebook and Tesla and all those are a good deal. Or was it temporary buying, the Fed or PPT? And where it matters is if it's the former, meaning genuine dip buyers that plan to hold those positions. That's bullish. It shows that there are more buyers in the market. The sellers have dried up at this point in time. If it's the latter, attempt by the government to stabilize the financial markets, then that's going to be a temporary effect. And the reason is those are not long-term holders. They would have to exit those positions, infuse a bunch of cash to buy stock futures. That's usually what they'll do to support the markets. Makes me think of Newton's third law of motion, which says for every reaction there's an equal but opposite reaction. So in other words, you take X number, massive amounts of stock futures contracts. You don't just buy them and poof, you hit the buy orders are gone. You own them. Somebody owns them, and somebody must sell those positions if they're not long-term holdings. And so that would just, in other words, all that's going to do is temporary bias time. Once those positions have to be unwound, once everything stabilizes, they have to sell them and get back out, and it's probably not going to be up here. Probably be sooner. We'll see. Again, that's just kind of me trying to figure out what might be going on. But the most important thing is, I just want to reiterate, this should give concern for those short, or give encouragement for those long. And you have this development, these bullish developments, and if you're long now, a stop below the recent lows, and if you're short or want to get short, that's where your next objective entry will be. I think it'll be a massive support level at this point, even though it's a single reaction low. Based on the video I did yesterday, so many individual key stocks and sectors and even the indexes hit support at that time. So it's not only a simple reaction low, it is also big support levels that have taken out, and then it'll undo whatever happened yesterday, and it will show me that that wasn't genuine buying, that there are still more sellers in the market. And you want to take a very simple approach, turn off all your lines. I'm sorry, these moving averages are there. Remember, we are still in a downtrend. That's all we are in. A downtrend is simply a series of lower highs and lower lows. And that's all we have in the market at this point. And that's all we'll have in the market up until these are taken out. And if those are taken out, again, I'm on a daily chart here. You have the key 200-day exponential moving average there, the simple moving average there, which acts as support and resistance. And you have those previous reaction highs right there. So this is really the line in the sand if you want to give it one. I really try to refrain from saying there's any one single level that all of a sudden flips the longer term outlook to bullish or the longer term outlook to bearish. It's incremental. You guys know me and my little check marks, and that's it. That would just be a massive check mark for the bulls and big X, red X for the bears if that level's taken out. And so you have to then figure if you are short right now and we're going to go for a test of that level, well, that's 7% right there. Are you okay with that? If you shorted up here where the average, the original entries were, you should be. But if you've been shorting, and I highlight objective short levels along the way, then you have to decide what you want to do, whether you want to start scaling out of your short positions now. You can always add back in there, or if you want to ride it out again, if you're going for the bigger gains. So those are the levels to watch and the developments. And the next development, turn back the lines, would be to see a bullish crossover, a solid cross of the PPO, that orange line going above the white line. And then remember, we have this trend indicator here. I have the red line on QQQ on the PPO about 0.88. So we'll call that negative 0.9, and it does a good job. I'm scrolling back here, defining bull and bear trends. I look at the white line, the 90 EMA, last two to cross. When the signal line right there, the 90 EMA, is above there, the trend is bullish, as it was throughout this entire period here, from here to here. As it was, we had a bearish crossover, and it told you, hey, early on in COVID, the trend is bearish. Moving averages were taken out. It got you out of there. It got you short, and since then it said the trend is bullish until right here. So it's cross currents, guys. I wish I could sit there, and if I sat here and just showed you every little bearish development on the charts and ignored the bullish developments, that would be a gross example of confirmation bias, and I wouldn't be doing my job. So I want to point out that this is a divergent low. It's the first one we had in a while, and give you levels to watch, mainly the previous reaction highs at moving averages. And this downtrend line, it's premature because it's not very well defined. I only have the highs right there, or just off the highs, and then that reaction. But it would also come in with the back test of this minor uptrend line. I gave you that a couple weeks back, saying if we break that, that should trigger some selling, and we did it. We took it out. So this is sort of a potential bounce area here. It's going to be pretty decent resistance. And again, I'm going to walk down and show you some levels on the 60-minute chart and then 5-minute chart, and we'll wrap it up. Can't go into all the indexes, otherwise this video would go forever. And again, this is the one I'm trading, so this is the one I'm most focused on. For the fact that it's very top-heavy in the market-leading FANG stocks, which are the same components, top components to the S&P 500. All right, now we're going to play around with fibs. A couple weeks back, I did the fun with fibs video. I highlighted when after this major reaction low, we came back to that 50% Fibonacci retracement level in QQQ about the same time that the S&P hit the 61.8. So the way Fibonacci levels work is now that was at that point in time a major reaction low. And as I often talk about, it's not always that way. It's not a guaranteed thing, but typically counter-trend rallies, during a downtrend tend to stop anywhere between that 38.2 fib, there's the 50, up to the 61.8. That's a typical retracement of what's simply a counter trend bounce, and that certainly proved to be the case there. Now, fib traders will put on what they call fib clusters, and we can do that here. Fibonacci clusters, you start taking all the major reaction highs. Now, at this point, we have to then, let's take this, because now we have a new low, and so I'm going to put the line there. And let me turn this one off real quick. So there's the all-time high in the Nasdaq 100 down to the low, and you can see right at this point in time, this is nothing but a counter trend rally from this perspective. I'm talking, there's different perspectives. We've taken out the 23.6. I usually don't have that one up. That's a minimal retracement, but you can see we're still well shy of even the 38.2. So, to do any damage, we're going to have to take out, like I said, price-wise, the levels I told you a minute ago in those previous reaction highs. But you could even come all the way up here to 375 and still be just a 61.8 counter trend bounce and turn around, and that's all it'll prove to be in hindsight. So you start going above that level, well, you're taking out the previous reaction highs, you're taking out the 61.8 fib, and that's going to be a big, giant, fat check mark for the bulls, increasing the odds that they're going to take the market back to new highs. And my point is, there's a way to go before that happens. We'll watch it day by day. I'll do this, I'll do updates next week. I'll do updates, maybe one at the end of the day today. I doubt it. I'll probably cut out early. It's Friday. I don't see the markets doing much today, so if anything big happens, I'll do an end of day update. But I just want to show you where we're at. And then Fibonacci clusters. What you do is you look at other previous highs, reaction highs. You can change the colors if you want to make it stand out a little better. And then you start seeing where these clusters come in. There's another reaction high. You can see how the lines, it's just always never fails to amaze me. These lines come in together, and so those are clusters, and you can put up as many as you want. Again, you want to look at the major the distinct reaction highs and of course change your colors. So that's how you play around with fibs. And again, fib traders will use these clusters. And when you have a lot of clusters that line up together, then that is a pretty significant resistance level, as far as Fibonacci levels go. And my thing is, I've always said this, some traders use fibs exclusively. Some use price levels exclusively. Some use Elliott wave. I like to use it all, particularly price levels and fibs. And again, it never fails to amaze me how often that my price levels, which I first put up on the charts, then I put the fibs later, and the fibs almost always line up, quite often I should say, line up with key support and resistance levels that I have. So let's do this real quick while we're here and show you that just put that up. So right now, from that reaction high, we're at the 50% fib. I know you can't see it in the video. If I had a way to make these numbers bigger, I would. I'm just reading it out to you. There's the 50% fib on the purple line from that move down from this reaction high we're at right now, as well as a 32.8 from this reaction high right here. And those two come in together. There's a fib cluster. And I'll take this one down real quick, and I'll move it down to this reaction high. And that one there, and you can see, let's see, that one we're already past the 61.8, probably at the 76.5. But these are things I'm looking at, guys, and so far my point is, the takeaway is that we're just in the realm of a normal counter trend bounce so far. I will say again, for the for the bearish case, I don't like those divergences. And that, especially if we don't fade the rally into the close today, if we build on the gains, or even now, you may want to take some short exposure off because of that. That could be the catalyst for a much bigger rally here if these play out as they normally do. So, all right, that's that 60-minute chart. I just went over the fibs. Let's just talk what's going on there price-wise. Let's go to this board. This is the simple view right here. We do have, remember I told you on the futures that we burned through the divergences. I'm talking about NQ and ES. There's NQ, at least the PPO divergence on the 60-minute chart was burned through. ES kind of hanging on by the skin of its teeth, but there. And on the Nasdaq 100, we do have it. And this is again looking at the 60-minute chart of the Nasdaq 100. I have all my other lines off. and you can see big positive divergence. And this is at least since pretty much every big correction we had since COVID hit 2 years ago, all the major bottoms happened, and I pointed them out with these 60-minute divergences on QQQ and SPY, and it's there. And again, it wasn't on the NQs because the NQs had that big tank night before last, but you do have it there on both SPY. Look at that. That's big, clear divergence. And this is, again, something that needs to be noted, and it could be the catalyst for considerable more upside over the coming weeks. So wish we didn't see it for the short case, but and I'm still hanging in there now with my trend positions. But if we continue to build on it and I get more and more check marks, bears, those little check marks will just scale me out, and I'll end up with what currently, as through yesterday, was a very, very big profit. And again, I've been trading this down, on NQ and QQQ, going long at the recent lows, gaming that back. So overall, I've done much better than the market's dropped, and it's fine. Sometimes that's part of the game. You have to get back profits, and the thing is, you just limit that give back, and that's what I'm looking at now. I'm more concerned about where to stop out than where to add, because I'm not going to add at this point in time. I don't plan to add until we take out the recent lows. If I change my mind on that and I see an objective shorting up for some reason, I'll talk about, I'll let you know. And I'm also speaking to trend trading now. I'll get to active trading in a second, but I just had to point out these divergences again and reiterate that they have been confirmed, and on the 60-minute time frame, not yet on the daily. And then QQQ, let's see, what other board do I want to show you? That's it. Resistance, we're coming up right now. We've got resistance here. I'm going to move that line up just a hair to tighten up with those previous reaction lows. For all intents and purposes, we're right at resistance now. Why is that resistance? This reaction low there. Then we back tested it from below once we took it out. We also had several tests of it there from above, one right there, one there, and a big gap right there to define it. So it's not super solid resistance, but it's decent resistance with the next resistance right up here. So, and then I'm going to get to this in a second. There's a nice trend line here. Let's do that. Let's just wrap the video up by jumping down to the 5-minute chart for you active traders. So, couple weeks back, in several occasions, I shared what I was seeing and trading actively on the 5-minute charts. It's one of my active trading, day trading time frames. And you can see right now, this is a trend line off the lows, pretty well defined in QQQ that will most likely bring in some selling. You have negative divergences on this 5-minute time frame building, and you also have resistance here right now at about 344. So active traders could take a shot at resistance, but I wouldn't go to a full position until and unless that's taken out, or you wait till the trend line's taken out, and that's probably going to pull us back down at minimum to 337. And so if this happens today before the close, then it comes back to that weekly chart I was just talking to you about earlier, where we're going to close back down on right on that key level, and that'd be my bet for today. We'll see. It's hard to say. If the shorts get squeezed, it could ramp into close. But again, I always say this: support until unless broken. But that's level I'm watching. And if you wanted to day trade it, you take a shot if it breaks, or you take a shot here right around that 344ish, 345. You have a reaction high right there. And if you hit that target, that's going to be about a 2% pullback, a little over 2%, or from where the trend line breaks should be about 2%. But there's no sell signal yet. You just have a bounce into resistance. Okay, and even though I typically, not always, there are times I'll trade the S&P over the Nasdaq 100. But even if I'm trading NQ, which I'll be doing today, if I'm around, we get the break of that trend line, I'll throw on a short. I want to see SPY breakdown as well, and because that'll help confirm. Because sometimes you'll get a breakdown on, let's say this is SPY, but let's say NQ broke down, but SPY was still above the trend line, then NQ might prove to be a whipsaw. So when they both break down, you have much better odds. And one of the reasons, among others, is that there's a subset of traders trading ES or SPY, the S&P 500, and there's other traders trading the Nasdaq 100. But these are both the large caps, so if they both break down, you have a better chance of that breakdown sticking. And on SPY, if that breaks down, I would say we're coming back down to about right minimum to you come back and hit today's yesterday's closing price, which is right there, and we have support. So I'll call it a support zone just below that, roughly here. You can also see at the volume price histogram, it gets real thick up here, the histogram bars, and then it's thin down here. So that's also support right there. And that would be a drop from where we're at now. If the minimum top of that target zone's hit, about 2% again. So there's a potential trade, but again, we're above trend, and you want to see them both break, and that's for active traders. Or let's say you're a swing or trend trader, and you're betting that this bounce is just going to get faded by next, later today or sometime next week, and you're looking for a place to short. Or you're looking to get long now after what happened yesterday. And you could do that as well. If you get the pull back to that level, you're getting in at a little better prices. All right, for now, let's see how today closes. But as I told you in the beginning of the video, I don't think on the time frames that I'm looking at for trend trading, I don't think we're going to get any clues. We're going to park it back on a back test of the recent levels that broke down, and so we'll probably have to see how we follow through next week. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.